Hey everybody, Rob Maurer here, and today we are talking about Tesla's possible equity distribution. A lot of people have been calling it a capital raise today, and it may very well be, but we'll go into the details on that. Also, the implications that may have for S&P 500 inclusion, and just a quick update on how that looks after the stock split. And then we have a bit of news on Model Y out of Shanghai as well. So, Tesla stock on the news today was down 4.7% to $475.05, but a pretty steep drop from the after-hours trading yesterday and the pre-market trading today, where Tesla actually peaked around $540 per share. Still though, even with that drop today, Tesla's still up post-split. Remember, the split happened around $442 per share. I've gotten a lot of questions on why it would drop today. I never know. You can't know for sure. But it did drop on the news of the potential capital raise, which we'll obviously go into more detail on here, but many brokerages have seemed to have some issues with handling the stock split, which has made, in some cases, trading unavailable for some people. So there may have been a decent amount of shares locked up yesterday. It seems like a significant amount of that has been freed up today, so many of those people in those circumstances may have decided to take some profit off the table after the run that we've seen the last even couple of weeks. There's been some theorizing around the internet that maybe some of those brokerage issues were caused by naked short selling, which essentially means you're selling a share short that you have not actually borrowed from anyone. You're just sort of creating your own little share to sell to someone, with the expectation being that if you would need to actually deliver that share at some point, you could go and borrow one. But the theory is that the split caused some problems for people in that position because of the need to deliver the 4 extra shares, which has then resulted in some of the scrambling that has caused some of the share lockup for this period. Personally, I'm relatively skeptical of that theory. The only reason that I really bring it up is because, number one, I've heard people having issues with their brokerages the last couple of days, and number two, to provide an example of things that may not necessarily be known that could also influence the stock price, rather than just the news of the equity distribution today. Alright, getting into the possible capital raise then, I'm sure by now most people have heard that this morning Tesla disclosed in a filing that they have entered into an agreement that will allow them to raise up to $5 billion in cash through a follow-on offering of Tesla stock. So that means Tesla could sell shares into the market, they keep the money for those shares, and use that for their business purposes. Those shares, if and when they are sold, are newly issued shares, so that ends up increasing the outstanding share count, diluting existing shareholders, but for the exchange of the new cash coming into the business, which can increase the value of the company. Now, in this case, what's particularly interesting is that normally when capital raises happen, follow-on offerings happen, there's a fixed price and a fixed number of shares. So a company is going to say, okay, we're going to sell 20 million shares for $100 a share and raise $2 billion. That is not what Tesla is doing here. So this is an equity distribution agreement, also known as an at-the-market follow-on offering, which means that Tesla, as the issuer, can work with the banks that are helping facilitate this transaction, 10 different banks, to decide based on the price that day if Tesla wants to sell any of this offering at all. Tesla spells this out very clearly in the filing, saying, quote, "We will designate the maximum amount of common stock to be sold through the sales agents on a daily basis or otherwise as we and the sales agents agree, and the minimum price per share at which such common stock may be sold." End quote. So Tesla could end up raising $0 from this if they don't like the price that they're getting from the market. They could also raise $5 billion or any amount in between. And they get to make this decision on a daily basis or even more frequently as they say there if they agree to that with the banks facilitating this offering. Tesla just sets the minimum price that they'll take, and if it doesn't hit it, well, that's fine. Tesla doesn't need to raise that capital then. Tesla highlights this point in the use of proceeds section in the filing, saying, quote, "We may issue and sell shares of our common stock having aggregate sales proceeds of up to $5 billion from time to time. Because there is no minimum offering amount required as a condition to close this offering, the actual total public offering amount, commissions, and proceeds to us, if any, are not determinable at this time." End quote. As far as what Tesla would actually use any capital raised for, they say, quote, "We currently intend to use the net proceeds from this offering to further strengthen our balance sheet as well as for general corporate purposes." End quote. So personally, I am thrilled with this. Tesla now has the ability at any given point in time, any single day, to raise up to $5 billion. If the stock price surges in any particular day for whatever reason, Tesla can offer some shares and opportunistically raise some money. Maybe they decide they only want to raise $1 billion or $2 billion. They have that flexibility. The only real disadvantage of this kind of structure is that you're not getting that fixed price. You leave yourself vulnerable to a falling share price. So if you actually need the capital, sometimes those fixed prices can be better because you're assuring that you will get that capital. But if you don't need it and you're just trying to raise opportunistically, then this is a perfect structure. My point of view has mostly been that Tesla doesn't really need to raise capital. They've got a lot of cash on hand, and I think free cash flow is about to start to really ramp up these next few quarters. So even with the market cap being what it has been, I've basically been of the mind that if Tesla feels like they need to raise the capital, I'll support it, but it doesn't look to me like they need to, so I'm just as happy if they don't. And this seems like a perfect middle ground. I like the amount as well. Obviously, it could be anywhere between $0 and $5 billion, but even if it is maxed out at $5 billion, and even if it's roughly around the share prices that we're at today, let's say $500 a share, that's 10 million new shares. Tesla, after the split, has about 931 shares total outstanding, so that's about 1% dilution only that you're looking at to raise possibly $5 billion. Even if you don't think Tesla needs capital, that's such small dilution. Having that cash on hand, as Tesla said, would improve the balance sheet. That can go a long way in improving their credit ratings. That can allow them to access cheaper debt. There can be a lot of benefits of that cash. I wouldn't advocate for it, but they could use that to pay down some of their outstanding debt, cut those quarterly interest payments that we talked about last week, which would lead to Tesla retaining more of their cash, better profitability, whether they chose to let that flow through all the way to the bottom line or reinvest it elsewhere in the business. So overall, I am very happy with this, and this brings me to the next point, which is the possible implications for S&P 500 inclusion. As we have talked a lot about now, I've done 3 separate episodes on S&P inclusion. If the S&P committee does decide to add Tesla, that means that the roughly $4.6 trillion in assets tracking the index would need to purchase a lot of Tesla stock. As I had mentioned in those previous episodes, it would not be unprecedented for the S&P committee to actually approach Tesla and see if they would be interested in doing an equity raise prior or as a part of inclusion in the index, especially so in Tesla's case where there's not a ton of free float and the value of the shares that need to be bought are so high. I would be very surprised personally if the S&P committee did not ask Tesla if they would consider doing an equity raise. Having those additional shares in the market could help ease some of the pressure that may occur when that volume of shares needs to be purchased by index tracking funds. So for context here, I wanted to again walk through our example of just how many shares would need to be purchased by these tracking funds. So the S&P index is a float adjusted market cap index, meaning the weighting of the index is determined by each company's market cap, but it excludes shares that are held by insiders that are unlikely to sell or maybe even can't sell. So shares that are not considered part of the float shares which are available for trade. So Yahoo Finance estimates Tesla's float shares at about 742 million post-split. At $500 per share, Tesla's float market cap would be about $371 billion. The total market cap of the S&P 500 right now sits at about 29 trillion. So to get Tesla's weighting in the index, we can just divide that 371 billion divided by 29 trillion, and we get a weight of 1.27%. As I said, there's about $4.6 trillion in funds that track the S&P 500. To get Tesla equal weight, they would need to have 1.27% of that $4.6 trillion in Tesla shares. That's $58.6 billion. At $500 per share, that's 117 million shares. Those of you that have been paying close attention may notice that that's not exactly 5 times the 26 million shares that had been needed before. I think what that's coming down to is the tracking assets. Since I last went through this example, the S&P index is actually up 12%, yet they still say that the tracking assets are 4.6 trillion, so that hasn't been updated yet. If we add another 12% onto that, we're actually at about 5.2 trillion in tracking assets right now, which then, if we put that number in instead, gets that Tesla share count requirement back up to about 130 million, yet again demonstrating that the number of shares that need to be purchased doesn't actually change that much relative to Tesla's market cap. It's more a matter of how expensive those shares are to acquire and how valuable they are at the time of index addition than it is of the share count. Long story short, these tracking funds need to buy about 130 million if they want to be equal weight Tesla when it is added to the index. As we've talked about, it's unclear exactly when that buying can start and stop. I've been told that that can actually happen before the announcement does happen, but a lot of people have disagreed with that. I stand by it, but still think that most funds are probably buying around the time of the announcement or after, so I'm still not thinking that a lot of this has happened yet. If 130 million shares need to be bought, Tesla doing an offering and selling some shares into that demand might be helpful so that we don't get some huge spike, which can cause some problems both for the company and for the index, even though investors do like to salivate about that potentially happening. So back to this equity distribution agreement, or the possible cap raise. It certainly seems like it's structured to take advantage of a price spike, if there were to be one, to help smooth that out, while also raising some capital at a nice price for Tesla. That's obviously very speculative, but the timing is definitely interesting. We're coming up now on the time where I think would be most likely for an inclusion to be announced. Remember, we have the rebalancing of the S&P quarterly. That'll happen on September 18th. So an announcement could happen 1 to 10 days before that. So the timing is pretty interesting here. And the last piece I'll add on this S&P inclusion stuff is that in addition to the 4.6 trillion tracking the index funds, there's 6.6 trillion in funds that are benchmarked against the S&P, meaning the performance of those funds is compared against the performance of the S&P 500 index to determine compensation, bonuses, things like that. Tesla at 1.3% weight, if it is included in the S&P index, a lot of those fund managers are probably going to want to have at least some stake in Tesla, if they don't already, because Tesla's performance is going to swing the index that they're benchmarked against. So if they're not included in that swing, there's a variance there, and they need to make sure that they feel good about that. Some of them probably do, but others probably don't. In aggregate, to be equal weight on Tesla, they would need to own about 168 million shares. So these numbers are a little bit more flexible than the actual tracking funds, but there may be some additional demand for shares from that group as well upon inclusion. In total, these share counts represent a pretty big chunk of Tesla's float. If we're at about 130 million for the tracking funds, that represents about 18% of Tesla's float, maybe another 23% or so from those benchmark funds if they were equal weight. In total, about 38%. That's a big chunk that a portion of would need to potentially be bought if this is announced. So that's why we spend so much time talking about this, and why the tie-in with Tesla offering the capital raise and structuring it in this way is so interesting. Of course, long term, a lot of this stuff doesn't really matter at all, but I still think it's fascinating to kind of watch all this play out and to see the different positionings and things that are happening in real time. All right, moving on from all of that, we have some exciting news that I haven't had a chance to get to on the podcast yet, but on Friday, Tasmanian posted an article. They actually had a reader that had sent them a photo of a camouflaged Model Y being driven around on a trailer in China. At the time, Tasmanian said that they did not have any way to know whether or not it was a made in China Model Y, but later in the weekend, Ray for Tesla, who has gotten some good information out of China in the past, tweeted, quote, "Just confirmed with an EV industry watcher in China, the test vehicle in the report below is indeed made in China Model Y," end quote. So obviously take that for what it's worth, secondhand information coming off of Twitter. But either way, exciting to see that camouflaged Model Y pop up in China. As far as why it's camouflaged, I wouldn't read too much into that. We saw made in China Model 3s pop up that were also camouflaged. People thought it was going to be a long wheelbase version. That never came to fruition, at least as of yet. So I'm not reading into the camouflage, but I'm excited to see the Model Y there and continue to believe that Tesla will surprise with the progress from Phase 2 out of Shanghai. To wrap things up today, we do have, unfortunately, a really sad note here. Another EV content creator, Jack Randall, over on EVTV. He's also done a lot of writing on electric vehicles over the years. Unfortunately, lost his battle with cancer and has passed away yesterday at the age of 65. So I know a lot of people out there watched his content. I never had the chance to meet him, unfortunately, but very well-respected individual, and I think we were all lucky to hear a bit of his perspective, even if on occasion we had to watch it at maybe 1.5 or 2x speed. So again, thoughts to everyone that was associated with Jack. If you would like to send flowers or a sympathy message, you can do that to the family. I'll put a link to that down in the show notes, but that's where we'll leave it for today. I'll see you guys tomorrow. Thanks.